idea phase. So we're saying that the CAC in our idea is $300. We think we can convert customers for $300. The AOV eventually is going to be $179 per month. So that's the price. So I think we can just call this price and AOV. We can put that down below as well. And then gross profit. And then the gross profit here is the AOV times 80%. So we're saying that it's an 80% gross profit margin. Then we're saying the customer lifetime value, we think that the average customer will be a customer for 24 months. So 24 times our gross profit per month, which is $143, ends up being $3,437 of customer lifetime value. The LTV to CAC ratio is we make $3,400. We only spent $300 to acquire that customer. So we actually make 11 times our CAC. Our LTV to CAC ratio is 11. And I'm saying that a CAC target at a minimum should be 5 for a SaaS company, and 5 to 10 is ideal, and best-in-class companies can even have an LTV to CAC ratio more than 10. This puts our CAC payback. So what do I mean by CAC payback? I mean, once we spend the money on the customer, how many months does it take for us to generate enough gross profit to actually recover our CAC? So I'm saying that we make $143 a month of profit, but we spent $300 in marketing to acquire the customer. So it takes roughly 2.09 months to repay the $300 CAC. So sometime in the third month, we're basically get into the green on the customer's lifetime. And we're going to cover that here in the cohort once we get into the MVP phase. And the payback target, I'm saying you should be trying to pay back the CAC in 6 months or less. One quick thing, this payback target, this depends a lot on the fundraising market. In hotter fundraising markets, companies are willing to generally have a longer payback target because venture capitalists are more willing to do bigger investment rounds for companies to effectively finance those longer payback periods and higher CACs. And then in weaker fundraising markets, you generally want to shrink the payback target. You might not grow as quickly because you won't be paying as much for the CAC, but it'll be more profitable, slower growth. And so in a weaker market, these numbers might be a little bit lower. In a stronger market, they may be a little bit higher. Okay, so now let's talk about our MVP. So let's say we launch the product and we get our first 10 customers. That's how many customers we have. The CAC ends up being $300, and our AOV at the time is only $99, our price. So the gross profit in the beginning is only 60%, and the LTV, we're saying on average, we think customers will be customers of ours for about 6 months. So the LTV is about 356. So the LTV to CAC ratio is only around 1. But if it's over 1, it still means you'll make some amount of money on each customer. So an LTV to CAC target in the beginning, if you're over 1, just kind of on the first couple customers, that's a good sign because you know that you can have further price increases and you'll be able to improve your customer retention. So this is a good kind of proof of concept. CAC payback, we're saying, is 5 months. So let's look at what do we mean by 5 months. So this over here is called a customer cohort. This is called cohort analysis. So for the MVP, we're saying that in month 1, customers pay $99. In month 2, they pay $99 plus another $99. So this is a cumulative revenue. By month 3, each customer has spent $297. By month 5, they've spent $495. And by month 6, they've spent $594. So the gross profit cumulatively is your customer lifetime value. So in month 1, we're saying this times 60%. So we've made $56 per customer. And by month 5, we're saying we've made $297 of cumulative gross profit per customer. So what we're really looking at here is the payback period and how it actually works. So we know that we spend $300 in month 1 to acquire the customer. And then in that very same month, we make $59 of profit. So our customer lifetime value post CAC is negative $241 because we spent $300, and so we're negative $300, and then you add the $59 to it. And the next month, you you no longer have the CAC, because once you've acquired the customer, there's generally no more marketing costs that go into the relationship with your customer. So now we're generating more uh, customer lifetime value. So you can see that it takes about 5 months to actually generate enough cumulative gross profit to pay back the CAC. And it's here in month 6 where we're in the green and we have positive $56 after CAC on the customer lifetime value. So when you see 5.05, that's what we mean. 5 months, and just in the beginning of the 6th month, we end up being in the green on our customer lifetime value versus our CAC. So payback target, it could be 1 year. In the beginning, like I said, you just want to have a positive LTV to CAC ratio. The higher the better. If it can be 2 or 3, that's even better. So now let's say we're getting to the early stage. So now we're scaling. We have 96 customers, we're saying. The CAC has been stable. We're able to continue to acquire customers at the same CAC, but we've been able to increase the price from $99 to $129. And then we've been able to, with that price increase our gross profit margin to 80%. In addition, in the first couple customers, they were only on for 6 months because our product wasn't perfect, but now customers are sticking around for 12 months. So 12 times 103 is 1238 customer lifetime value. And so the LTV to CAC ratio is now 1238 divided by 300. So that's 4. And so I'm saying that in the early stage, if your LTV to CAC is sort of between 3 and 5, that's where you want to be as you're scaling, because that means you put in $300 of marketing and you make back over $1,200 of gross profit, and you can run a profitable company with those types of metrics. So in this scenario, the CAC payback target we're saying is 2.91. Again, this kind of depends. Early stage, the payback target, I might say more like 9 months. You don't want to be spending too long recovering your CAC in this stage. Now we're getting into the growth stage. So this is when we need to really start scaling up our business. So we're going from 96 customers to 2,360. So we're saying that our CAC stayed the same. We've now increased our price another $20, and now our customers, instead of staying on for 12 months, they're staying on for 15 months. So our LTV to CAC ratio has increased even more to 6. And so our LTV to CAC target we're saying is 5, and our payback target we're saying is sort of 9 months or less. And in this scenario, we're paying back the CAC in only 3 months. And finally, as we move towards the late stage and we increase the business another sort of 10 times, we're saying that the CAC is similar. Let's say we're getting a lot of referrals. We've started a big referral program. We're getting a lot of organic traffic. So we've been able to keep our CAC low, increase the price to the original $179 that was in our idea. That has allowed us to have $143 of gross profit per order, and we've extended the customer lifetime to an average of 18 months. So now we're at an LTV to CAC ratio of 8.6. And so in this phase, if you can have an LTV to CAC ratio of 5 to 10, then that's fantastic. And if you can pay back your CAC in 6 months or less, then that puts you in a really, really strong position. So you can see in this business, each marginal customer, so all the customers between 96 and 2,300, we're making more money per customer. We're making 400, then we're making 1,200, then we're making 1,700, then we're making 2,600. And so this paints a story where the bigger we get, the more money we'll make from each customer. So the end state of the business, even if this business here is doing, let's say, $50 million, we think that if this business does $1 billion, the LTV might be 5,000. And so we think that the end state of the business is going to be better than the current version of the business. And with a business with a lot of growth in front of it, that's the story that you need to believe for people to invest in the company or to be acquired by a larger company, that the business is going to be worth much more.